Hello, this is Gary Sherman of Whaddadunce.com. In this series, we're going to talk about bank valuation. I come out of the banking and Wall Street world, so banking is something I know a lot about. I started out at Deloitte, where I got my CPA, had a few banking clients. Then I transitioned into a California bank where I was treasurer. And we actually took that bank public in 1995. So that was my first experience with Wall Street. The underwriter for our IPO deal was Montgomery Securities, which was eventually acquired by Bank of America. And we ran the company as a public company for 2 years. And I wrote all the annual reports and quarterly reports and all that stuff. So I got some experience there, which was great. And then we sold the bank in, I think, 97 to Bayview Capital. And then Bayview Capital took me on. I moved from Santa Barbara to San Francisco. And by that time, I was out of grad school for economics. And then I went to Bayview Capital, where I was the head of the mergers and acquisitions, the quant side, as VP mergers and acquisitions. Um, I did about $1 billion worth of deals, about 500 million equity deals, 500 million in securitization. Securitizations are something I really enjoyed, for whatever reason. Then I got my CFA and I transitioned to Turwin Money Management, which was a Wall Street firm specialized in subprime CDOs. And if you know anything about subprime CDOs, you'll know that that was pretty much the kerosene that exploded the economy in 2008. So I got to see the CDO business collapse from the inside, which is fascinating. So with that introduction, we'll go on with the components and the methodology of valuing banks. In part one of this series, we're going to talk about the bank business model. And the traditional bank, what they do is they'll take in deposits and then they'll lend those deposits out. So if they pay X percent on taking those deposits in, if they pay their depositors X percent, what they'll do is they'll turn around and lend it out to small businesses, um, credit cards, auto loans, and all that kind of stuff at X percent plus. So the bank's primary business is to earn a spread between what they lend the deposits out and the rate at which they pay on the deposits. But that's only about half of the bank's revenue source. Half of their revenue comes from the spread business. Then the other half comes from non-interest income, which is primarily fee-based. Banks will charge fees on for loan origination fees. They'll be involved in the servicing business, also asset management. As I mentioned in the previous slide, Bank of America acquired um, Montgomery Securities, so it was in the asset management and trading business. And then in part two, we're going to talk about bank returns. Bank returns is where it's at. We can make the general statement that if a bank's return on equity is greater than its cost of capital, it'll trade at a premium to book value. And if a bank's return on equity is less than its cost of capital, it'll trade at a discount to its book value. And we'll talk about the components of return, net interest margin. That's interest income minus interest expense. Then non-interest income, which is primarily fees, and then non-interest expense, which is their employees, depreciation on your buildings, computer systems, and all that kind of stuff. Net charge-offs, which is whenever a bank lends money to whoever, it expects a certain percent of those loans to go bad. So we'll talk about net charge-offs, or basically losses given that borrower defaults. We'll talk about income taxes, then the leverage ratio. The leverage is where banks. That's primarily the bank's business. What they do is whenever they lend out their money, they'll earn a spread, and what you'll find out is that return on assets, or if you take the total bank income minus expense and divided by assets, their margins are very, very, very small. When we took a look at Costco, I think Costco's margin was around between 4 and 5%. So for every $100 in sales, about $4 of that went to Costco's bottom line. But banks have even less of a spread. Most banks have a return on assets of less than 1%. So there's not a lot of room for error there. And then, but leverage is where it's at because, in order to get a 1% ROA into something that's, greater, they'll use a lot of leverage. And then in part three, we'll talk about Bank of America and we'll do a valuation of that bank, which should be fun. What we do at Whaddadunce.com is that if I want to value let's say in this case a bank, what do I have to do if I was just sitting at my desk with just an empty spreadsheet and a folder with nothing in it? What you would have to do is you have to go out and get the annual reports from the bank, extract their financial statements, both their balance sheet and income statement. You would have to calculate its cost of capital, and then you would have to calculate a whole bunch of ratios. And that's very, very time consuming. And what we do at Whaddadunce.com is we provide all of that for you. So the all you have to do is go into a library of companies. Right now we have 100 public companies. Select that company, and that's basically the green box to the right. You would select that company, and then that company would now be part of your group. And within that group, you would have various members, so you could work as a team. And the software does all the ratio calculations for you, has all the financial statements, even the notes to the financials. I mean, everything you would possibly need is there for you to conduct evaluation and even evaluation models. But at the end of the day, you're responsible for plugging the assumptions that you come up with into the models using the data that we provide. And at the end of the day, this is what we're all about is handing regular people the ability to actually value the common stock of the companies that they may be interested in. I use it all the time for my investments. So come join our community. And with that said, we will begin the series on bank valuation.